Mike and Tom are registered with Stewart Partners Global Advisory LLC.
Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom.
All right, everybody, welcome back to another edition of Common Sense Finance. I'm Mike Wiginton, and this is Tom Farrell. Tom's going to be walking us through a conversation today about hedging strategies on your stock portfolio. And so with today's March the 5th, 2020, the last couple of weeks, we've had a lot of volatility over this coronavirus thing. And so the market's been down as much as 14% off its high, very much in correction territory. As we sit here today, we're off about 10%. So this hedging idea may be something that's on people's mind. What say you?
Yeah, there's a lot of different strategies you can use to hedge your equity portfolio. And we get questions from time to time. People, especially now, people are nervous about what's going on in the market. So we wanted to go through a few hedging strategies. While right now, in this point in time, may not be the best time to start implementing these strategies. We're not saying it is or it isn't, but historically, maybe after the market's already gone down, it could be a little too late for that. But we wanted to just share some thoughts that you could implement, just so you know what's out there available to you. Now, there's a lot of different strategies you can use. Some of them are more aggressive than others. So we're going to talk about the least aggressive first, and that is just moving some assets to cash. Having extra cash, and knowing if you normally have 10% of your portfolio in cash, of your equity portfolio, you may want to increase that to 15 or 20, depending on how much you want to hedge that portfolio. Now, the downside to that is, hey, if the market continues to go up, continues to do well, that cash is not going to earn near as much as your stocks will. So you have some opportunity costs. But if the market does pull back, it cushions the blow because you don't have as much invested in the market, and it also gives you an opportunity on the other side to buy some investments when they're a little bit less expensive than they were before.
Well, you're very right about that drag on your portfolio return, as far as cash being that drag. And that's just a conversation folks have to have with their advisor about, because that's very much a subjective, how you feel about risk, what your allocation should be. And it's generally when the market's at all-time highs when, we say, hey, we want to have that conversation. But again, that's something that there's no set rule. There's not one size that's right for everybody. And a conversation ought to be having, like you said, in advance.
Yeah, absolutely. And these are more strategies for I guess, I hate to say short term, but these are not, it's not like, hey, we're going to change our overall investment strategy for somebody that's a long-term growth investor that needs to have a higher percentage of their assets in the market, in the stock market. This is for, hey, we're going to make minor adjustments here and there going forward. Sure. So the other way to do that is increase your percentage to fixed income or into bonds. Now, you can cushion your stock market downturn by doing that, because bonds typically do not have as much fluctuation in their value as equities do, but there's a downside to that too.
Yes, and so a lot of times what people will do, they want to use fixed income as a substitute for the cash balance, because generally they can earn more money on bonds than they can on their cash. So they say, well, let's increase my allocation to fixed income. Well, the catch on that is that you better use very short-term bonds if you're going to do that, because even short-term bonds can move around a little bit, but they don't. But long-term bonds will move around a bunch. Okay, they can for various reasons, both credit issues and movements in interest rates. But the point is that I want to make about that, in today's world, I think we all know how low interest rates are. You're not really making anything on short-term bonds.
It's not worth going out.
You would argue, hey, there's not much of a spread between cash and short-term bonds.
Right.
So why not keep it in cash? Yeah. So that's just something, again, that you have to analyze with your advisor.
Yeah, and that strategy is probably not something that's going to be give you a big advantage in today's interest rate environment.
That's right.
The next strategy, now the next couple I'm going to discuss are a little bit more aggressive hedging strategies. Buying put options. Now, you can buy put options. Most equities that are traded on the exchanges are puttable, meaning you can buy put options against that stock. So a put option works in your advantage when you think the price of the stock's going to go down, and you buy the put options, and the price of those options goes up inversely to the price of the underlying security. Now, one strategy is to buy puts against, say, the S&P 500 index. So you can buy puts against that, and if you own something similar to the S&P 500, maybe you have some S&P 500 ETF, and you buy those puts against the S&P 500, then if the market goes down, your puts are going to go up. So it offsets losses for you. But there's also a downside to that too.
Yeah, and in our world, buying puts on the S&P 500 or your portfolio in general is considered a fairly conservative thing to do. However, the problem I have with it, and this is certainly the downside, is that all options, like puts, they expire. They don't have an infinite life. Like if you own IBM, as long as IBM is in business, not bankrupt and gone away, I mean, you can own the stock.
Yeah.
Once you pay that premium for that put, you've got to be right, meaning the market's got to go down, or else that put's going to expire, and and there goes with it all your premium.
And it has to go down in that time frame before your expiration.
And certainly the put is sellable. There is liquidity for that. You could go and say, well, I think this thing's going to expire. The market's not moving down, so I want to sell it. But you're going to find that the percentage, generally speaking, the percentage of that premium that you're going to recapture from selling, it's not going to be that great.
Right.
So therein, I'm paying for something that's got a limited life expectancy, and I've got to be right during that time.
Yeah.
And that's always been my problem with buying puts.
Yeah, and unlike
as a hedging strategy.
Yeah, and unlike my next hedging strategy, shorting, the only thing you're risking by buying a put option is the premium.
Absolutely.
That's the most you can lose. So if you pay $3,000
Yes.
for a put contract on the S&P 500, that's all you can lose. Yes. Now, with shorting securities, your losses are infinite.
Correct.
Yeah.
Because theoretically, the stock or the mechanism that you're shorting could go up infinitely.
Yes. So we don't recommend that as a strategy, but just to let you know, that is a strategy that some people employ, is shorting a security. And we won't go into a lot of details about how that works, but if you have questions, you're more than welcome to call us or shoot us an email. And then the last hedging strategy and again, this is probably not something that would make sense for most people, is using an inverse exchange traded fund. So you can buy these exchange traded funds where they perform in the opposite direction, or they're supposed to, in theory, move in the opposite direction of whatever the underlying security is. So you can buy an inverse ETF on the S&P 500. If it goes down, your ETF should go up. So some people use those as hedging strategies, but again, those things sometimes they don't perform as well as they are.
Or like they're advertised to work.
Right, like they're advertised.
Happened.
So they don't, the correlation's not exactly right with those and how they're supposed to act. So we typically don't recommend those for people. But anyway, those are just a handful of things you can do to hedge your equity portfolio. And with that, thank you for joining this time. If you have any questions about this or anything else we've discussed, please give us a call. We'd love to talk to you. Thank you.